Just finished off the week with a really nice long in the PM session on gold. In this video, I want to quickly walk through that trade, the confluences, and try and keep it very actionable so that you can look for some of these similar situations and signatures. To start with, just want to quickly reiterate why I was super bullish. Essentially, both gold and silver had this major pullback, failing to substantially break structure, which is indicative of a squeeze type theme. We saw that squeeze theme playing out with clear reaccumulation on Thursday during the New York session, rallying into Friday, and then we had this aggressive pullback from these old highs. So failing to hit a key buy side pull, premium internal range, having this sharp pullback, and that's where we are right here. What gave me the confidence to take this long, if I drop straight to the 5-minute chart, is understanding that we're in a squeeze. One of the common features of a squeeze characteristics is that we fail to break structure to the downsides, then continue to squeeze up. And the logic behind that is, let's say someone is, for example, over here, let's say someone was trying to go short with a stop above the high. They're likely going to think, okay, well, minimum TP would be if when we break structure or when we break this low. When price fails to do that and instead takes internal range and then rallies, that is indicative of a squeeze theme in that we're trapping traders offside. We see that exact same dynamic happening over here. So while understanding the high time frame is in this kind of theme, this kind of environment, we then see the same thing with NFP having this aggressive up move after taking out sell side. We then begin failing to take out lows, make that a bit more obvious, but failing to take out a low right here. Then once again, a really obvious sell side pull. We sell off during lunch, fail to take out that low, and then start rallying back up. That's the first clue that we are definitely squeezing. Then the next thing is, well, one, we got buy side up there, but also we left all these smooth highs through this range. Really sharp sell off. Anyone chasing that short, they're going to look to sell the pullback. If you look over at this chart, you can see I've got this indicator on, which just shows that you the hourly opening prices. So 10 a.m. open there, 1 p.m. open there. But what you'll notice is that 1 p.m. opens, it does not take out the previous hourly candle low. You can see that over here on this hourly charts depiction. Fails to take out that previous candle's low, aggressively moves up. This is like a fractal of the same type of scenario where we're failing to take out the previous candle's low, rallying back up. What this does is it also suggests a squeeze where traders will be looking for a short to make a new low on the hourly candle. But when that never happens, that a lot of the time results in the squeeze up towards the highs. This is a framework that I call the squeeze reversal, and I'm going to walk you through how I executed it right now. When I see the situation when we have a squeeze reversal, failing to take out the previous candle's low, I then look for the hourly candle that made that low. In this case, the 12 candle, the 12 p.m. candle. So 1200 down to the low, that's the range. The midpoint of that range is what I call the SR mid, it's just the midpoint. And what I want to see if we are going to squeeze is I want to see us get above that SR midpoint. And since this is an hourly time frame squeeze reversal, I want to see a closure through a displacement and a closure through it. And then the very next candle needs to open and close also above that midpoint line. When that happens, it indicates a strong closure, a event horizon essentially. And at that point, it confirms that the squeeze is underway and we should not return back to the area that sent us on that move. And the logic behind that is that in this area, this is kind of the area where traders were still under the illusion that we were going to pull back and then sell off again. So the fact that we consolidated here a bunch, we even did a 3 drive pattern. Traders would have seen that, got bearish, and then we ripped through those highs. So this point right here is where traders are now trapped offside. This is what I call the impulse origin. I anticipate that we will not return back below the swing low essentially, but usually we don't even touch the opening price that created that down move or that started the up move. So that becomes the impulse origin. A lot of the time price will retrace very deep towards that line or that area, but it will not go below this low, because if it would, the whole narrative behind the trade of there being trapped traders down here would be invalidated because they'd be let off the hook. We then consolidate, drop down very close to it. We spent a whole bunch of time in this area consolidating. That's enough time for traders to get trapped offside. We then climb back into the range, engineer a short-term low, and rally. So at this point, I'm very interested in the long. I can see that we've got these smooth highs up here, and I'm really keen to get long. But what I need first is a confirmation that we are, well, I don't need it, but ideally get a confirmation that we are in fact going for these highs. I have a very specific way of looking for that, and I'm going to show you that to you right now. I used this technique multiple times this week, both to confirm trades because of a failure of it and because it worked. So what you do is measure out. So I'll start down here actually. You're looking for the level of buy size we've just hit. So what liquidity pool have we just rated? Well, we just rated this liquidity pool. You then draw that line between that and the very next obvious swing high on that time frame. That is the liquidity gap. That's the gap between the liquidity pool here, and then there's a area with no major swing highs or lows where there's going to be a lower amount of liquidity in this range compared to above these highs. When price gets above the midpoint of that range, which you can see right here, and closes above it, that is indicative that we're actually going to continue to at least that high, which is all you need to accumulate a position in this range and catch the run up. So I saw that closure up there. That confirmed me it was bullish. I then got long quite early on because so a bit of an early entry to be fair. But with the logic that we had trapped traders down here, and we should not return down to this area because the same thing as over here, they would invalidate the idea of these traders being trapped. So I initially had my stop loss down here. We dropped quite close to it, but you'll notice we failed to take out these lows. We then consolidate, engineer a bunch of short-term lows down through this range, rally up, have this aggressive sell-off. Now at this point, it's sold off really aggressively, large down closing candle. But what's interesting is that it takes out this deep discount internal range low, but fails to take out the external range low. And once again, that's the same kind of pattern we're seeing over here. A really obvious low. We come really close to it, but fail to break it, then trade back up. So that was another clue that we're looking for a squeeze. And then following that, another very key clue is that we have this here. So you see this long work on the 5-minute time frame. This is a concept that I call the manipulation closure. Essentially, when you get some sort of expectation in price that fails to hold how you'd expect with the closure, but then it continues to reverse anyway. So usually, if you measure out the midpoint of a wick like this, a closure below the midpoint is indicative of bearishness. However, when that happens and the very next candle reverses back up, that's what I call manipulation closure. And a lot of the time it becomes a longer term swing point, or it can also be an area we return back to in the near future to reaccumulate, which is a beautiful example of this on silver from, if you look at this area here on silver, not gold, you'll see the exact same thing happening right there. But that's kind of beside the point. Manipulation closure instantly reverses back up. At this point, very high probability this will hold for at least a nice run up into these highs. So I added when I saw that. Took partial up here at the highs. In fact, it's quite a nice fill. And then it drops back into the range right here. Now this sure wasn't ideal, but I trusted that this manipulation closure should hold if we're going to be bullish. And the reason why I jumped back in here is if you look at this, I will show you how to measure an actual order block. So obviously ICT is the one who taught order blocks originally. He teaches from the open, just using the bodies basically like that. However, that is not actually the correct way to do it, in my opinion. In my observation, you get a lot more accurate results when you measure the opening to the low of the candle. Measure that across, we respect the midpoint of that, and reverse straight back up. And what I really liked about this is that you'll notice that this is 3 p.m. right there. It's 1500 candle open, new hourly candle, dropping into that order block, respecting it, getting this initial reaction straight back out. You'll see compared to my normal, like a lot of the time when I execute on a live account, which this is, I've emptied it out already by withdrawing, but a lot of the time when I execute on an account like this, like I'll take partials way too early. But in this case, held them a bit longer than I usually would. And that was simply because of the confidence level, seeing how everything was playing out, and also the fact that 3 p.m. was the candle that had this aggressive drop, then reversed straight back up. That sends us nicely up into these highs, hitting these premium internal range highs. There's a great target right there. You'll see I took one more trade over here. Logic being that we hadn't hit the target yet, we hadn't hit the hourly high. We had this impulse origin, same as down here. Trapping traders short below these smooth highs, aggressively ripping it back up. We have a nice sell side pull for this impulse low. We dropped into that, got long, but the reason I closed because it was after the close. It was basically 4 p.m. on a Friday after I'd had a really good week. And I thought, well, there's no point finishing off the week with any kind of loss because, yeah, there's literally no point. So I just moved to break even and got stopped out. But yeah, that will summarize the entire thing for you. But in summary, when you are expecting a squeeze, you want to see trap traders offside, and you want to see us then failing to take out lows and break structure. And you want to just imagine, okay, well, if someone is, let's say, trying to short this pullback, where are they going to put their stops? Likely there. Or if they're trying to short the pullback here, they're probably going to put their stops near the high. And when you then see us fail to break structure to the downside, aggressively reverse back up, start showing these signatures of accumulation, you can trust that we should get a really nice squeeze in towards those highs.